Looking at the potential of 5 days of gains in a row. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, tariff rates are coming. President Trump says he'll set the cost of doing business with the U.S. himself in coming weeks. And easing trade tensions, fueling a 4-day winning streak with the S&P 500 on track for one of its biggest weekly gains this year. Plus, we'll round out the week with a mega merger, a major CEO shakeup as well. A lot going on with these stocks. Katie, what do you got?
Well, I want to start with that CEO shakeup. This breaking news from this morning that Novo Nordisk has ousted CEO Lars Fruergaard Jorgensen after the stock's roughly 50% fall since mid-2024. That comes, of course, with growing competition for its obesity drug, Wegovy. You're taking a look at ADRs right now. This is a Danish company, but ADRs down about 3.7% at the moment, had been down as much as 5% pre-market, Matt.
All right, and Charter will buy Cox Communications in a nearly $35 billion deal that unites two of the biggest U.S. cable providers. Right now, you see Charter Communications shares down 1.33%. Cox, which had been fully family-owned, the family now gets a 20% stake, a little bit more, 23% stake on the new company.
And on the trade front, President Trump says he will set tariff rates for U.S. trading partners over the next 2 to 3 weeks. He says that the administration doesn't have the capacity to negotiate so many deals at once.
And we have, at the same time, 150 countries that want to make a deal, but you're not able to see that many countries. So at a certain point over the next 2 to 3 weeks, I think Scott and Howard will be sending letters out, essentially telling people, it would be very fair, but we'll be telling people what they'll be paying to do business in the United States.
Annmarie Hordern, Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance, is in Abu Dhabi, where she's been following the president's visit. And Annmarie, it looks like we've got the major trading partners, the EU, China, Japan, India, in talks. And with the rest, the president's just going to offer them a deal, yes or no?
Well, this is what the president has said a number of times. Most recently, last week, I was in the Oval Office with the president when he was announcing that deal with the United Kingdom. And he was asked about where their other trade deals linger. And he said at some point, there's so many partners, we're just going to set the deal and let them know. He said that again today, talking about these trade deals. He says that are in the hopper. The fact that the Commerce Secretary, Howard Lutnick, the Treasury Secretary, Scott Bessent, may end up just sending a letter to those countries, maybe giving them a phone call and telling them this is where we've decided on the tariff rate. Remember, a lot of these countries already have a tariff rate from April 2nd, Liberation Day. All of that has been put on pause. This, I think, is an indication that the administration knows some of these rates were just too high, and that for a number of these countries, they're going to come down. But if there's no formal negotiations, they're just going to reset the rate.
Annmarie, I want to go back to this concept of capacity, that the administration just doesn't have the capacity to negotiate so many deals at once. I go back to the trade deal with the United Kingdom. That was custom made. That wasn't necessarily a blueprint that can be applied to a bunch of countries, rather. So it makes sense that when it comes to our big trading partners, they would need a bit more time here.
Well, yeah, also the Financial Times this morning has a story about Japan may actually hold off on a deal a little bit longer. The prime minister's feeling really a lot of heat from the automotive sector as well as domestic farmers about making too many concessions to rush into a deal with the United States. So this might not be very simple. The Treasury Secretary on the course of this Middle East trip talked about the fact that Europe has as a collective bargaining problem. So when you look at even some of these big massive trading partners, the talks are still lingering. And when you get a comprehensive trade deal, that can take years, not months, not weeks, years. So for a lot of these big trading partners, it's likely going to be terms of agreement, memorandum of understanding. But to get a comprehensive trade deal, that's going to take a lot more time.
All right, Annmarie, really appreciate your reporting. That is Bloomberg's Annmarie reporting from Abu Dhabi, where she has been following President Trump. We want to go back to one of the big corporate stories of the morning, and that is Charter's $34.5 billion acquisition of Cox, which will create the largest cable company in the U.S. For more on this deal, we're joined now by Michelle Davis. She is Bloomberg's senior deals reporter. And Michelle, I guess it's not surprising to see this because you think about John Malone. He, of course, is the chairman of Liberty, which is Charter's largest shareholders. He specifically named Cox as a potential merger target all the way back in November.
Yeah, so this is one of those perennial deals that's been talked about for literally a decade. In the cable industry, when you look at the chessboard, there are only so many combinations that can be made. And in November, John Malone said he thought Charter, because of the increasingly competitive environment that's facing the cable companies, he said they should be allowed to combine with someone. He named Cox as one of those people. He named T-Mobile. He also named Comcast. And what's really interesting about this deal is that, there's this whole narrative that it's really tough to get big M&A done right now, but these two companies felt that the competitive environment is so intense that they really do have to combine to better compete.
Yeah, so Charter is buying Cox. And these assets, these cable assets, are just shrinking as obviously everybody cuts the cord, right? So who's next?
Well, this kind of leaves Comcast out in the dust, but they have more of a diversified business model than Charter and Cox do. And what's really interesting right now is that the cable companies, which obviously had traditionally gotten a lot of their revenue from cable, pay TV, they moved over to getting a lot of their revenue from internet, but everyone has broadband internet already. And at the same time, the big wireless companies like T-Mobile, Verizon, they're also offering internet like Verizon Fios. And so it's gotten increasingly competitive. And so companies like Cox and Charter, they're starting to offer mobile phone service. And so the big question is probably what does one of the next phone companies do to try to push back and continue to be competitive in this environment?
Yeah, and it's interesting to see that Charter shares are a little bit higher right now, even though this is a very big price tag. Appreciate the time. That is Bloomberg's Michelle Davis. Meanwhile, the other big news of this morning coming from the corporate front, that is Novo Nordisk ousting its CEO, Lars Fruergaard Jorgensen. He took the helm in 2017. He presided over a stock price surge of nearly 700%. That's until competition in the obesity shot market from Eli Lilly in particular turned investors into skeptics, leading to a halving in the share price in the last year. I spoke with Jorgensen just a couple weeks ago about the company's outlook.
When we lower the guidance for the full year, it is really because of what the impact was of compounding in the first quarter and probably also a bit into the second quarter. And we have a relative steep comparator in the second half of the year. So you should see this guidance as one of us really stepping up in the second half of the year and getting to more and more patients and really moving forward in a business environment.
And that was on May 7th. It's May 16th, and Lars Fruergaard Jorgensen is out as CEO. Bloomberg health reporter Madison Muller joins us now for more. And Madison, I think it's fair to say that this was pretty surprising.
Yeah, it's definitely a surprise. Lars has really successfully launched one of the biggest products of pharmaceuticals ever, and deserves some credit for that. But and Novo really helped make this obesity market that we've been talking so much about. I mean, there's two companies really in this space. It's Novo and Lilly, and Novo was first to market with Wegovy, and the problem has been that they just have really struggled to convince investors that they're going to be able to follow that up. I mean, they've had supply issues. They've had disappointments with their next generation trial results. And what we're seeing now is that a company that really rarely changes its leadership. I mean, they've only had a handful of CEOs ever, and the tenure of CEOs tends to be very long. Lars himself has been there for almost 3 decades, not as CEO, but has been at the company for a long time. So this is really a surprise move for a company that rarely makes moves like this.
Madison, how much longer is Ozempic/Wegovy expected to be a blockbuster drug? I mean, are we looking at a situation where they're going to face generic competition challenges in the near future?
Yeah, so semaglutide, which is the active ingredient in Wegovy and Ozempic, that is coming off patent within the next few years. They're also going to be facing drug price negotiations under Biden's Inflation Reduction Act in 2027. So the price of that drug could actually come down substantially. And time they're facing pricing pressures from compounded drugs, and they're also facing increasing competition with Lilly. And we've talked about some of these partnerships that Novo and Lilly are doing with telehealth companies to sell the drugs at a cheaper price to consumers. And so there's definitely pricing pressure on the drugs anyway. And we have Lilly coming with a weight loss pill and another next generation shot that has close to 25% weight loss in trials, and Novo just has not been able to do that same thing.
All right, Madison, thanks very much. Bloomberg health reporter Madison Muller talking to us about the changes at the C-suite at Novo Nordisk. Some more movers on our radar. Applied Materials gives a tepid forecast, and as a result, the shares are down about 5%. It seems to be all about the forecast this earnings season. Then Take-Two Interactive, it's moving up right now, but it's delayed, I guess, the Grand Theft Auto 6 again. This has been an issue. Did you play Grand Theft Auto?
No, that is not really my speed, but it doesn't bode well for their 2026 outlook and trying to conjure one.
Yeah, it's obviously expected to be their big blockbuster. Coinbase has been a disaster lately. After the gift of going into the S&P 500, it faces a lot of issues.
Well, it's interesting to see it higher pre-market. It had a terrible day yesterday, of course, with news of that hack and that SEC investigation, according to the New York Times, but higher by 2.5%, and soon, on May 19th, it'll be in your 401k through the S&P 500 inclusion.
All right, our Bloomberg Intelligence media analyst is going to react to the Charter-Cox deal that creates the top cable provider in the U.S. next. This is Open Interest. Let's get now to high interest and look at what's making headlines around the world. New Jersey Transit has failed to reach a contract agreement with train engineers, resulting in the first major transit strike to hit the state since 1983. It affects about 350,000 commuters a day. A wage dispute is at the center of the fight. The union has been pushing for the rail workers' first raise since 2019, while New Jersey Transit calls the proposal unaffordable. Another round of negotiations is set for Sunday morning. And the U.S. Justice Department is launching a criminal antitrust probe into how Live Nation and AEG responded to mass concert cancellations at the outset of the COVID pandemic. The investigation focuses on whether the companies illegally colluded on refund policies. Live Nation is denying any wrongdoing. AEG Presents didn't respond to requests for comment. And billionaire Bill Ackman is calling for the resignation of the entire Harvard board, claiming they are presiding over the destruction of this once great institution. Ackman has been highly critical of his alma mater for its response to anti-Semitism on campus over the past 18 months, saying that only new leadership can fix this mess. The university is also locked in a high-stakes fight with the government, with Harvard accusing the Trump administration of threatening academic freedom after the White House froze billions of dollars of federal funding to the school. And back to one of this morning's top stories. Charter agrees to buy Cox Communications in a deal valued at $34.4 billion. The combined company will create the top broadband operator in the U.S. Joining us with more is Geetha Ranganathan, Bloomberg Intelligence, a media analyst. So, Geetha, what do you think persuaded the Cox family ownership to sell here, and what does this mean for the whole cable landscape?
Yeah, thank you so much, Matt. So, the cable industry, the cable broadband industry especially, has been under intense pressure over the past few years, especially from, the telecom players. So you've had Verizon, T-Mobile, and AT&T kind of come out with new products, both with fixed wireless access, which is also, cell phone-based internet access, as well as fiber. And so cable is kind of facing this double whammy on both ends of the market, both competing in terms of price as well as in terms of quality with fiber. And so this is really a response to that. Cable broadband had the lion's share of the market. It still does, but just a few years ago, it dominated the broadband market, the U.S. broadband market, with about almost a 67% share. Now, thanks to that intense telecom competition, we're down to about a 60% share, and it looks like, they will face this competition over the next few years as well. So this is really just a response to that intensifying competition.
I want to talk a little bit about the logic. I mean, it seems to make sense, obviously, investors agreeing with that when you take a look at Charter moving 4% higher now pre-market. But reading through some of the reaction, it seems like the bet here is on convergence. This idea that in the future, customers will want to buy their internet, their mobile phone services in the same place. Is that your view as well?
Absolutely. And so cable has normally been like the fixed broadband side has totally dominated. And of course, you have the telecom operators on the mobile and the wireless side. And this is really both parties, so both cable and telecom, have been getting into each other's space. And cable now, for the past few years, has really kind of racked up a good number of mobile subscribers. And yes, they are trying to offer a discounted, converged bundle, both with the mobile and the broadband product to really kind of retain those subscribers. And that is absolutely the play here. Charter has been extremely aggressive in this, price-led strategy with mobile convergence. And this is exactly the rationale and the logic behind this deal as well, Katie.
Who's next, Geetha? I mean, as these cable companies shrink away to non-existence, which is the next one to get bought?
Yeah, we have, quite a few other players as well, smaller players, including, Cable One, including Altice USA. The problem with a lot of these smaller cable players, Matt, is they have just tons and tons of debt. And so leverage is definitely going to be a huge issue. Of course, you have the biggest, or before this, the biggest cable operator in Comcast. They had the largest number of broadband subscribers. But again, I think for them to do any deal and get regulatory clearance, that's going to be a bit of a challenge. So still a few players left, but we'll have to see what happens next.
All right, Geetha, really appreciate your insight. That is Geetha Ranganathan of Bloomberg Intelligence. And I will say, Matt, you have shares of Charter higher right now in the pre-market. Year to date, they're also crushing it on a total return basis, higher by about 22%. We know how the rest of the market is doing.
Yeah, amazing, especially considering the fact that no one subscribes to cable anymore, right?
That is the albatross in the background. Let's look at these broader markets, though. The S&P 500 trying to climb for a fifth straight day, currently higher by about 0.3% in the pre-market. You have big tech also up there with the NASDAQ 100 higher by a similar degree, and it's small caps that are out in front with the Russell 2000 currently higher by 0.5%. We're going to start the trading day with Sarah Hunt from Alpine, Saxon. She says that the real-world effect of the last 6 weeks of trade rhetoric has yet to be seen. That conversation up next. This is Open Interest. Welcome back to Open Interest. One of the big calls from this morning, Bank of America's Michael Hartnett saying that emerging market stocks are expected to be, quote, the next bull market due to a weaker U.S. dollar and China's economic recovery. Joining us at the desk to discuss is Alpine Saxon Wood's chief market strategist, Sarah Hunt. Sarah, it's great to see you. Happy Friday.
Good morning. Happy Friday.
So let's start there, because that's a big, bold call, one that I feel like we've heard before, and it never quite pans out when it comes to that EM outperformance. What's your take?
I think that it depends on a couple of factors, as he even put in the note. If China recovers and the dollar stays weaker, those are two big ifs for that call to work. And I think that if those two things happen, there will be some outperformance. But then the U.S. will also perform really well as well, because if China is doing well, it's because we've sorted out some of the trade issues enough that they are well enough to bring up the EM. So I think that that's a call that will overall be good for all markets entirely.
There was a time, obviously, when EM was all the rage and when all of the most important people on the street were moving to Asia. But that was decades ago. Are U.S. investors really comfortable going that far out the risk curve when they've been doing so well here at home for the last 15 years?
I think that's sort of been one of the issues, is that the U.S. market has continued to outperform. I mean, I also think about it's Europe's year, happens all the time, and you do get some uptick in some European stocks, but the U.S. markets tend to, over time, perform better. There may be a period of time in which the EM does well, but then the dollar does have to stay lower, because if you get any resurgence in the dollar, that's very tough for EM markets.
Well, what's your dollar call? It feels like so much right now is actually predicated on the dollar. And you think about where the first order effects of all this trade rhetoric is going, it's being expressed in currencies. So we talk about potential EM outperformance. You also include Europe in there as well. I mean, it seems like that's really a currency call at this point.
Well, I think that the strength of the dollar was knocked down on some of the issues that have been going on in the last 6 weeks. It probably needed to come down somewhat. Where it's sitting right now seems to be a reasonable place, but you have so much uncertainty on big macro calls, and people do express that in currency. I think that's one of the reasons that the gold price has been so strong, because people are looking for something that is X any of the currencies, because generally speaking, it's more of a question of which is the least bad place to be for the near term as opposed to what's the best place to be. So I think that where we are right now could be okay. If you get a lot weaker on the dollar, it's good for earnings coming into the U.S., but it's also problematic in other directions for us. So it's hard to say. I think right now it's all right.
Sarah, we're getting a headline right now. Zelensky and European leaders are talking to President Trump by phone. We get these red headlines with President Trump, 5-6 times a day, whereas with Biden it was like hit 5 or 6 times in his entire 4 years. Can you ignore this noise, or do you have to pay attention as an active investor?
It depends what the noise is about. I mean, there are so many things that are changing. As the trade headlines change, that has been a hugely moving of the market. The Ukraine-Russia issue hasn't moved the market as much as it would be a good thing if we could get it solved. But in the interim, the changes around that don't seem to be as moving of markets as the trade issues have been. But yes, you have to pay attention to that, because there is a lot of news that's being made, and it's very quick, and it changes very fast.
Right.
And it has moved markets, so yes.
All right, Sarah, you're sticking with us through the opening bell, and here's the setup as we count down. Green across the board on the S&P 500, the NASDAQ 100, the Russell 2000. We'll take you through all of the opening action up next. This is Open Interest.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at gains, although slight on futures. And we actually closed in the green yesterday, so we could be on track for 5 days in a row. One of the best weeks this year. NASDAQ futures also up. By the way, if the S&P 500 in cash closes at 59.79, we'll be back in a bull market. That'll be a 20% gain since the lows of April. You hear the opening bell of the New York Stock Exchange, ALS United, a charity organization, ringing the bell there. But down at the NASDAQ, you've got Galaxy. There's Mike Novogratz in an awesome shirt, and he's very happy because his stock is up more than 2,000% over the past 5 years. Katie, which stocks are you watching?
I'm watching Novo Nordisk ADRs like a hawk, because Novo Nordisk has ousted CEO Lars Fruergaard Jorgensen due to struggles with growing competition for its obesity drug Wegovy, which has led to quite a decline in the share price, about 53% since mid-2024. That was specifically called out in the press release, which was stunning to me. You can see ADRs down another 3% right now at the U.S. market open, down about 21% or so year to date, Matt.
All right, Charter is going to buy Cox Communications. We've been telling you this morning, in a nearly $35 billion deal that unites two of the biggest U.S. cable providers, and Charter shares are higher, 1%. Not always the kind of thing you see when there's a big deal, certainly not for the acquirer. We're back with Alpine Saxon Woods Chief Market Strategist Sarah Hunt, and another day, another deal. Is M&A really starting to pick up here?
I think it is. I mean, that's one of the things that we were looking forward to collectively as investors this year, was that you were going to have a better M&A environment because you were going to have a potentially less regulatory environment. It's interesting that this is going on, but if you think about all the different pieces that these players and all the different pipes into the consumer that they've had, it's not surprising that those are all changing now, because we get all that information in different ways. So, I mean, the market seems to be looking at this fairly positively, but pre-market it's been a little bit up and down. So we'll see how that reaction goes.
You've seen a few deals this week. You've also seen a few CEO shakeups. United Health earlier this week, Novo Nordisk today. It was interesting to see Novo Nordisk specifically call out the share price. That mid-2024, the decline since then, down about 53%. But there's plenty of companies who have fallen by similar magnitudes since that time. What do you make of that?
I think it's an interesting question as to what else was going on behind the scenes, because if it's just a share price issue, go back a couple of years and all of a sudden that share price looks like it's been much appreciated, as opposed to just looking at the period of time from when they almost had a monopoly on the substance to now. And I think that there are other things possibly from a strategic standpoint, like maybe they weren't developing an oral version of this, maybe there are other things that are going on, but it seems a lot to call out just a stock price move for this, especially such a short time frame for that.
Especially when you consider that Lars Fruergaard Jorgensen has been CEO since 2017. He's not new. In that time, looking at its peer group, Moderna down 80%, and then you have Biogen down by about 47% or so. So they're not alone in seeing these types of declines.
Yeah, not alone in companies that saved the world seeing these kind of declines, right? In terms of, Katie was going through stocks this morning that have halved in value in the past, year to date or the past year. There are a lot of them. You like any of those losers? Has anything been thrown out here after Liberation Day that hasn't recovered?
Well, I think that there are some things that have already started to recover, but that were part of this sort of picks and shovels of the AI pipeline. And you had a lot of stocks that were riding up on the idea that we needed to build a lot more energy infrastructure and a lot more data centers. And I think you've seen some of those come down to more reasonable levels. I think some of the main big seven have already had a pretty big move up in price, but there are some issues individually with some of them as well, like the Google antitrust issue and some of the other things that are going on. So I think that there are places where it's still interesting to look, but I think you have to be very mindful now of valuation and cash flow, because the equity market indices have come back so high, and a lot of those valuations have come right back as well.
I want to talk a little bit about where we go from here. We were talking about the other day how there's still a bunch of recession calls out there, not for an outright recession, but basically you can't take it off the table that it's a coin flip at this point. I mean, where do you stand on that? Because you take a look at the economic data, it's pretty much held up. You've had inflation come down a little bit. It seems like activity hasn't slowed too much, but it's the future that we're all scared about.
And I think that it's the fact that we don't know what kind of lags have gone on in the system because of this. Investors are very quick to look at data and want an immediate reaction. The real world doesn't move that fast. The ships don't come in that fast. So stuff that was canceled, stuff that hasn't been ordered, what ordering looks like in May, all of these things are going to matter a lot in September and October and November and into the holiday season. We don't know yet what that looks like. It could be much more problematic than we think it is right now. It's not fair to say that there's no inflation because of this, because we haven't really had time to see it. And you see companies like Walmart pointing that out right now and saying we're going to be raising prices.
What do you do, though, if we muddle through this? A lot of people would have said, this tariff announcement is an absolute disaster, just like Brexit was an absolute disaster. But then you don't see the British economy tanking, right? It's just kind of ground on.
And I think that that's one of the lessons that we continue to learn, which is that even when you have adverse circumstances, people still do the things. They live their lives, they go to work, they do a lot of stuff. If they pull back on the margin, you get an economic slowdown. We may have a shallow slowdown. It may be worse if you end up with critical component shortages. We don't know that yet, and I think that's part of the issue, and it may be why there's change in tone in terms of we're going to put some numbers on the board for people in the next 2 to 3 weeks, because the uncertainty is what hurts markets more. And right now we're back to thinking we can look through whatever this happens because it's not going to be that bad, while we still don't quite know what it's going to look like yet.
Sarah, great to have you on the program today. Thanks so much for joining us here on set. Sarah Hunt there from Alpine, Saxon Woods.
Here I go. It's time,
go.
Time for my walk and talk. Let's break down this market right now. You have the S&P 500 higher about 0.1%. All it needs to do is finish green for a 5th straight days of gains, which would make this one of the best weeks of 2025. If you look at breadth right now, you have 200 names in the green. You have slightly more to the downside, but it's some of the most important companies that are climbing right now. Alphabet, Nvidia, Tesla. When you take a look at the points basis here, what's contributing to the upside, those are your big guys. On the downside, though, you have a pretty big weight in Microsoft, in Broadcom, in Meta, and Applied Materials. an earnings story today. So a real tug and pull when it comes to the tech sector. And on that note, let's take a look at the sector level right now. What's gaining, what isn't? Right up at the top, you have communication services. A lot of that is coming from Alphabet, though Charter helping out a little bit as well. You go down the list, pretty much an even split, slightly more green, but at the bottom, you do have tech, that tug and pull that I was talking about, down only 0.1%, but at the bottom, materials off by about 0.4%, Matt.
All right, we're going to talk when we come back to D.A. Davidson's Gil Luria. He is calling for a complete breakup of Alphabet. He joins us next to explain his call. This is Bloomberg Open Interest.
Welcome back to Open Interest. A quick check on stocks here because that 5-day rally is fading a little bit. The S&P 500 still higher by about 0.1%. We were looking at more robust gains pre-market, but fading across the board right now. The Nasdaq 100 up by a similar magnitude, and you can see the small caps have given up their lead, now neck and neck with everyone else. We'll see how that develops. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC is upgrading Carnival on strong booking trends. The firm says that the company has made solid progress on its profit recovery. Next up, we have Foot Locker getting a downgrade over at Barclays. Remember, earlier this week, we learned that Foot Locker is being bought by Dick's Sporting Goods for $2.4 billion. And finally, we have Caterpillar getting upgraded over at UBS thanks to de-escalation when it comes to tariffs, some progress being made with China. That's worth an upgrade, but you can see shares down about 0.4%, Matt.
All right, a big earth mover to watch there. Let's get to another top call from earlier this week. D.A. Davidson's analyst Gil Luria says one of the biggest tech companies in the world would be more valuable if it was broken up. Luria writes, the only way forward for Alphabet is a complete breakup that would allow investors to own the business they actually want. And I'm pleased to say Gil joins us now. So, Gil, it's already worth quite a bit. How much do you think it would be valued at in pieces?
If Google was to break up into all its pieces into each individual business, we think the stock could be worth $300 a share. We think that right now, everything is trading at a 15 times earnings multiple. That's a very low multiple for businesses like Waymo, Cloud, YouTube, and potentially the TPU business. Those businesses would be trading at 50 times our earnings or more if they were independent. And Google is really holding them back by keeping them with search, which is now a tainted business, a controversial business that investors are really not willing to put a lot of value on.
Well, it's interesting to read this call in and of itself, but also when you put it against the regulatory backdrop right now, because you do have regulators attempting to break up this company, and you're saying, actually, this would be a good idea. Is this something that you see as actually likely to happen?
This is a catalyst. It's a potential catalyst. The Department of Justice telling Google, break up your monopoly is a potential catalyst. And the company should be leaning into that instead of dragging this out and dragging it out in court and having it influence all its decisions. Instead, Google could just say, OK, we'll spin off the ad network. That would be great, because then that business would trade like the Trade Desk, which, again, is much higher. And then they could spin off YouTube. Then that would trade like Netflix, which is much higher. Unfortunately, that's not what the management team is doing right now. Right now, they're just dragging their feet. They're going to fight it in court. They're going to try to keep the company intact, which, again, is not in the best interest of shareholders.
So why? I mean, Sundar Pichai, Ruth Porat, Ken Walker, these are smart people. Are they disincentivized to make a move like that as executives?
They are too focused on profits, on short-term profits. They know that if they spun off all these businesses into individual pieces, they lose some of the synergy of having them in one place. So let's say that instead of earning $11 a share this year, if all the individual pieces were broken up, they'd maybe only own $10 a share. But again, we argue that you're getting paid 15 times the $11. If you were able to get paid 50 times on some pieces of the $10, shareholders would own a much bigger business. So management team is focused on profits in the short term instead of focusing on shareholder value, which is their job.
And Gil, I will note that you're not alone in calling for this. You also have Needham analyst Laura Martin written that the company is worth more in pieces than together, echoing your call here. When you take a look at all the different components, basically all the parts of this business, what do you think the weakest link is?
The search business. While there was some argument whether the search business could continue to be a monopoly and grow at these rates, that really ended when the head of services at Apple pointed out that Google search is now declining on the iPhone. That tells us we've hit that watershed moment where people are chat GPTing things instead of Googling things. So that business, even if you believe that Google can maintain some of its monopoly here, clearly that's going to be controversial. Investors don't want to invest in a business that could be a melting ice cube, but they do want all those other pieces.
I've noticed that, did you realize the kids are calling ChatGPT Geppetto?
No. What kids? Who?
I've heard so many younger people say, which for me, that's a lot of people, right? But Geppetto. I feel like AI just cancels the need in some way for using Google search the way we used to, Gil, right? I mean, it's the first point of entry, and then you click on the results that you get from ChatGPT or Grok or Gemini, whatever you're using. So that seems to be, like Cox Cable, like it's done.
It does, because all Google gives us, right, is 10 blue links and a lot of sponsors around that, and we have to find the answer. The chats are giving us the answer we are seeking, and while right now that's all types of questions and some of them are not commercial, increasingly the chats are going to be commercial. What vacuum cleaner should I buy? Which toothpaste should I buy? What is the recommended medication and how to take that? What insurance is the best in this particular situation? The chats are going to give that answer. Once they start doing that, you better believe they'll start selling ads. And that's the point where advertisers, instead of putting all of their digital advertising budget into Google and Meta, are going to start having other choices. First and foremost, that's going to be these chat engines like ChatGPT or Grok, XAI. They're going to start allocating some of those digital advertising dollars there. The reason that hasn't happened yet is that there's no ads on ChatGPT yet.
Right.
They haven't turned that on. Clearly, they will. We're getting closer. The most recent hire they brought in is somebody that's an expert at selling ads. It's clear that that's where this is headed.
Yeah, it certainly seems that AI is an existential threat for the search business. Really appreciate your time on this Friday morning, Gil. That is Gil Luria. He is head of technology research over at D.A. Davidson. And Matt, one of the reasons why this caught my eye, this call that Alphabet should be broken up into pieces, is because spinoffs are so hot right now. Bloomberg actually has an index of spinoffs. The ticker there is BN Spin. And if you take a look over a long-term basis, we hit a record high earlier this year. We're going to pull up the chart. We've come back a little bit down, but
that's
back
10
again.
years.
That's 10 years. So you can see that, especially in the past just couple years, they've become even more popular. GE Vernova is a great example. It's up 30% year to date.
So it's true. And when you pointed that out, I looked it up on the comp screen. I always use comp.
It's
and
my
it
favorite
defaults
tool.
to 5 years. And the spin-off index has crushed the S&P and the NASDAQ 100 over the past 5 years.
Yeah.
But if you look at it over 10 years, then the NASDAQ 100 actually does quite a bit better. So
yeah, well, there's been more spin-offs in recent years,
a recent
so
thing.
that has helped performance a bit. Something we'll continue to watch on this show. But you know what else we're watching?
What else are we watching?
We're watching Novo Nordisk.
Yes.
It's lower. Eli Lilly is up right now on news that the Danish drug maker has ousted its CEO. We'll discuss next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. We are 57 points away from a bull market. Check it out. The S&P 500 right now trading at 59.23, so 56 points away from 59.79. That's where we need to be to climb 20% from the low in April. The NASDAQ 100 already there, gaining 0.1%, as is the S&P. Take a look at what's going on with some of the individual stocks. AMAT down on earnings, off 6%. Charter Communications, even though it's making an acquisition of Cox, it's gaining 2.7%. UNH gaining back a little bit of what it's lost, but it's gotten absolutely crushed over the last few days and really down 50% this year. Coinbase is rising after concerns yesterday of a hack and a potential DOJ probe. Eli Lilly up, and this is actually Eli Lilly, Novo Nordisk, Katie. Interesting, because this is the market, I think, saying, oh, Lars Fruergaard is out, let's sell that stock and let's buy Lilly instead. It's really the market, I think, making a judgment on Novo's move.
Yeah, it's really interesting to see. It's basically like a mirror stock reaction there in those two companies. So let's discuss it more now with Sam Fazeli. He is Director of Research for Global Industries and Senior Pharma Analyst for Bloomberg Intelligence. Of course, we're talking about the news that Novo is ousting Lars Fruergaard Jorgensen as its CEO. Their reasoning there was in part because the stock has declined so meaningfully since mid-2024. And Sam, I'm curious what this will fix, because you think about where Novo stands right now. They've lost market share in the U.S. market to Eli Lilly. They had underwhelming results for CagriSema. It seems like, it's going to be an uphill climb here.
Yeah, I mean, Katie, in the pharmaceutical industry, magic wands don't really exist. It takes several years to fix a pipeline or to change the direction a company is going. I'm wondering how much of just a rant this was by the shareholders saying, look, we've just had enough, let's move on. The company has done the sorts of deals that perhaps it should have done 5 years ago, looking for new assets, looking for actual orals, not oral versions of its drugs that are injected. And so it lost some of that, but it will take another 4 or 5 years for those things to come fruition. It's already done those deals now. So, but maybe this is just a way of saying, look, we realize that we lost some of that initiative. And if I may, I want to just highlight quickly, this is the company that was leading Lilly on everything. They were at least neck and neck on insulin. They were the first people to bring these GLP-1s to market for diabetes. They were the first to develop a really successful long-acting insulin. Here, they lost the initiative when Lilly developed Zepbound. That's when it all started happening.
Sam, I always think of the business matrix, with the rising stars, the cash cows, the dogs, the question marks that you learned about in college. I guess Wegovy and Ozempic, are they not rising stars anymore? Are they just cash cows now? And does Novo Nordisk have any rising stars in the pipeline?
Yeah, so Matt, this is a really good question. It's more about rising star, but whose star is rising most? And Lilly's star is definitely rising most. They've done all the right things. They took a gamble on this drug, tirzepatide, that became Zepbound. People didn't expect this to work like this. The biology was confusing at the time. And this is going back 7 or 8 years. So they took a gamble, not an expensive gamble, and it really paid off. Then they've got a real oral drug. Now they've gone for triple action. They're covering the bases. And of course, they have other business, cancer, Alzheimer's, etc. It's just a matter of relative rise, right? This market's growing. Wegovy will continue to grow, but I'll tell you who's going to get the most of the lion's share is going to be Zepbound for the foreseeable future. It's a better drug.
All right, Sam, really appreciate your analysis here on this big corporate news. That is Sam Fazeli. He is Director of Research for Global Industries and Senior Pharmaceuticals Analyst over at Bloomberg Intelligence. I also want to point out Viking Therapeutics. Of course, we're talking about the Eli Lilly rise on the heels of this news. Viking is working on an oral obesity drug as well, and shares are shooting higher this morning.
I always think about this. They seem to be in a race. Which one can make you lose more weight? But not everybody wants to lose 180 pounds, right?
For some, it's the quality of that weight loss.
If there's an oral drug where you only lose like 20,
yeah,
that would be pretty good.
Are you talking for yourself?
No. Coming up in the next hour, University of Michigan's Joanne on the latest consumer sentiment print. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. And let's get a check on these markets right now. The S&P 500 clinging to gains right now, a fifth straight day if it holds, up about 0.2%. Big tech hanging in there, as are the small caps. Of course, a lot can change between now and 4 p.m. and a lot can change at 10 a.m. Matt Miller.
Bad news from the University of Michigan. So the sentiment was expected at 53.4. Last week it was 52.2. It's below both of those numbers at 50.8. Current conditions also below the expectation at 57.6. The expectations at 46.5. So every single number so far is missing out. And then on the bad side of things, the worst side of things, I should say, the one-year inflation expectations at 7.3%.
Wow.
Far worse than the 6.5% we saw last month and also expected. So let's get over, I should say, to Mike McKee and break this bad data down. He's our international policy and economics correspondent. Mike, this is horrible.
This is horrible. See if it affects the markets, because, of course, it's not really going to affect the Fed, but they are going to be watching this closely, particularly the one-year inflation number, 7.3%. Obviously, a little ridiculous over the next year, but it does show how people are worried about inflation coming from the tariffs. And an interesting thing, and I know you're going to talk to Joanne in a minute, I think this survey would go to about Wednesday, and so it would have picked up some of the China pause, and apparently it didn't affect people's views. The 4.6% on the 5 to 10 is also a problem for the Fed. They look at the longer term moves, and mostly they've been expecting that to stay steady. They've been talking about that, and it hasn't. I just looked at the expectations index, 46.5. That is the lowest since May of 1980.
Wow.
I don't know where you guys were then. It was a depressing time, I guess. We were in recession, I think, at that time. So this does not bode well. With expectations, that kind of puts a lean to the idea that maybe people will cut back on spending more. And we saw in retail sales yesterday that people might have been starting to act on their concerns.
All right, Mike McKee, really appreciate your thoughts here as the market digests this data. That is Mike McKee. He is our international and policy correspondent. And for more on this data, I'm pleased to say that we're joined now by Joanne. She is Director of Surveys of Consumers at the University of Michigan. Great to have you here in the minutes after this release. As Matt said, it's ugly. Sentiment coming down, inflation expectations going higher. Just talk to us a little bit about what period this survey covers. Mike McKee was talking about it a little bit, that this should have the China pause reflected here, but certainly not showing up in these numbers, Joanne.
This preliminary reading for May covers about 3 weeks, of which 2 days were collected after the China pause. So we're not really going to see the full effect of the China pause until the end of the month. That being said, the early look at those 2 days of readings do see a very modest improvement so far, but clearly that improvement was not enough to offset the really dour views that consumers had. And this reaction is pretty consistent with what we saw after April 9th. There was a modest improvement after April 9th, a reversal of pause on reciprocal tariffs. But again, it really wasn't enough to bump people above where they were before the major tariffs were announced.
Why are the inflation expectations so high, considering we've been seeing prices come down for a lot of the key goods in the news? For example, and gas at the pump as well, something everyone sees every day, but egg prices have come down. And yet 7.3%, it's just off the charts, Joanne.
Consumers are, when they're answering this question about their inflation expectations, they're not giving a reading of what inflation is literally right now. They're giving their outlook for the future. And it's very clear that consumers are bracing for the impact of the uncertainty and instability of tariff policy. It's not just that the tariffs have been, the announced tariffs have been high, but it's the overall instability of tariffs and the uncertainty around it that leads consumers to believe that businesses aren't going to plan, and it makes it difficult for themselves to plan as well.
So there's the numbers themselves, these survey numbers. Talk to us a little bit about what you're actually hearing when it comes to comments that you're getting from consumers.
Well, a couple of things. One is, again, we have almost 3/4 of consumers spontaneously mentioning tariffs. That is the number one thing that's on their minds, and they're really worried that this instability and uncertainty around tariff policy is going to bring inflation back. And inflation has been the major factor for the last few years that has kept sentiment relatively low. And really the big worrisome thing for the future is that unlike the last few years after the pandemic, in which people kept spending because their incomes were strong, consumers are really worried that labor markets are going to weaken. And in fact, when asked about current assessments of their personal finances, we had a growing share of people telling us their incomes are already weakening. So this is definitely a concerning crack in the resilience of consumers. And they're bracing for impact not only of inflation, but higher unemployment in the year ahead as well.
What's the partisan split that you're seeing in these surveys, Joanne? Because in the past few months, we've seen Republicans expecting no inflation and Democrats expecting all the inflation. Is that skew still there?
So the really interesting thing about May is that there wasn't a ton of movement among Democrats at all in terms of their inflation expectations. They were high last month and they remain high this month. In contrast, Republicans, the increase in inflation expectations was very much driven by Republicans. Overall, they're still expecting lower inflation than Democrats, but they're expecting much higher inflation than they were just last month.
And I'm just curious to hear a little bit about what your job feels like right now, because we've been talking about on this program how it feels like every single data point is stale because the news shifts so frequently. The narrative can change hour to hour. And as the director of surveys, I'm curious, how it feels from your seat.
The really fascinating thing is that we are collecting interviews 365 days a year. So I'm able to see the evolution of comments that we're seeing from day to day. We report out the data every 2 to 3 weeks, but it's just really fascinating to see what it is that's on consumers' minds. And really right now, it's tariffs and inflation.
All right, Joanne, thanks very much. Joanne Shu there at the University of Michigan. For more coverage with Joanne, be sure to tune in to Live Go on your Bloomberg terminal, LIVE Go. She will sit down with Michael McKee, our international economics and policy correspondent, whom you just saw, for a live Q&A. This is really interesting that we have the highest inflation number since 1981, which was a time of real unrest. I mean, back then, and I wasn't there either, because I was like 8, but people were throwing rocks through the window of the Federal Reserve in Washington. Protesters were driving tractors through Washington and blocking the streets. People hated death threats to Paul Volcker, right? Whom we revere now in hindsight, but at the time. And yet you see almost no reaction to this in markets.
That's the thing with all that context, to see not really much of a drop when it comes to the different asset classes right now. I'm not sure how you explain that reaction. It might just be because who really knows? This is soft data. This is survey data. That's often hard to trade on.
It doesn't move stocks. It doesn't move bonds. And I guess I thought it was a really interesting question to Joanne about when the soft data comes through to hard, or the fact that it hasn't, and how she feels. And she was just saying, look, we have up-to-the-minute information, but it just doesn't come through in the data that moves Wall Street, I guess.
Yeah, I have to imagine that Mike McKee will have a robust discussion on that point on Live Go. You can watch that conversation. But let's get to some single stock movers right now. We've been talking about this all morning. Charter buying Cox for nearly $35 billion. That creates the top U.S. cable provider. And even with that big price tag, Charter shares up 2.7%.
Yeah, really interesting. Do you have cable?
I don't think so.
Do you know anyone who does? Do your parents still have cable?
You'd have to ask my husband. I don't deal with that.
Okay. CoreWeave is up 17% after NVIDIA reported a 7% stake in the firm, whose stock has already been soaring, right? It was already up 60% since its IPO at the end of March. And it's darn near doubling now, Katie Greifeld.
There you go. CoreWeave, co-founded by a Haverford graduate. On the other side, on the earnings front, you have Applied Materials, another check into this AI tech trade, gave a tepid forecast as China sales slip. You can see shares slipping by nearly 7% right now, Matt.
All right, coming up, private funds are more open to the masses than ever. Morningstar wants to rate them, and we'll speak with the CEO, Kunal Kapoor, next.
You also have New Jersey Governor Phil Murphy. He's speaking right now on the New Jersey transit strike. He says the state is seeking a, quote, fair and affordable deal. You can also listen through Live Go on your Bloomberg terminal.
90%. Even on the Amtrak lines, it is regularly in the mid to upper 80%. We mentioned last night, I think the board approved 250 new double-level, two-level rail cars this.
Let's get to high interest now. Look at what's making headlines around the world. President Trump says he is going to set tariff rates himself for the rest of America's trading partners over the next 2 or 3 weeks because his administration lacks the capacity to negotiate deals with all 195 countries in the world. The Trump administration is prioritizing trade talks with over a dozen nations, though, including Japan, South Korea, India, and the European Union bloc, with several deals expected to be signed soon. As we've been telling you, Novo Nordisk announced it is replacing its CEO, Lars Fruergaard Jorgensen, because of increasing competition for its Wegovy obesity shots and a 53% decline in its share price over the past 12 months. Novo has also faced setbacks in trials with new weight loss drugs. Jorgensen became the CEO in 2017, and the company's market cap has more than tripled during his tenure. He will stay on as CEO until a new leader is found. And HSBC is reorganizing its capital markets and corporate advisory units into a new business to grab a larger share of the booming private credit industry. The new capital markets and advisory group will house all of its various financing and investment banking activities under a single management structure. More players are being lured to the $1.6 trillion global asset class as borrowers look for safer options amid global trade chaos. Katie?
Well, another company turning to private markets is Morningstar. The firm has been grading stock and bond funds for years, but it's now going to begin rating less liquid private asset funds marketed to the masses. I'm pleased to say that Morningstar CEO Kunal Kapoor joins us now. Great to have you with us. I talked to a lot of fund managers, and a lot of them live and die by their Morningstar ratings. So talk to us a little bit about this move into now rating also these less liquid private asset funds as well.
Yeah, good morning to you as well. It's great to be on. And I just say that it's a reflection of where we are today in the world of investing. I came to Morningstar almost 30 years ago, and the public and private worlds were quite different. But about a decade ago, Morningstar bought PitchBook, and we've been gathering data on private companies first and then private credit. And today, there's more than 5 million private companies, for instance, that we're tracking. And all of that means that there's a growing interest. There's more assets that are in that space. And the reality is that it's largely been the purview of institutional investors. But when you look at the large pools of capital and you also look at the reality that individual investors tend to invest, for the long haul, there's a belief that they don't, but our data consistently shows that they do through vehicles such as the 401k. And it's become attractive to think about, how can you bring private assets, which are a bigger part of the market, to them, especially as public assets have become a smaller part of the market. And so we're particularly starting to see movement on private credit. In fact, in your headlines, you were talking about private credit as it pertained to HSBC, but broadly speaking, there's a lot of interest in private credit. And so you're starting to see the emergence of what are called semi-liquid investment options. They might be interval funds here in the US. They may be something like an LTAF in Europe. And the reality is that they're garnering a lot of interest, especially here in the US, from investors. And as they become a more significant part of the portfolio, who better than Morningstar to help investors navigate what it all means and how they can think about including them in a portfolio?
It's a good point. It's an obvious fit. I started as a research intern at Tucker Anthony 30 years ago and was always sent to pore over the Morningstar ratings for each fund. Katie points out that from her cross-asset desk, everybody she talks to is citing a Morningstar rating. How much of your business is it now, private credit, and what kind of trajectory do you expect?
Yeah, we don't quantify private credit. PitchBook itself is a very significant part of Morningstar's overall business. It's one of our largest segments today, and within PitchBook we have PitchBook Credit, and then we are now the world's 4th largest credit rating agency in Morningstar DBRS, and a significant portion of the issues we're rating are on the private credit side. But what we started to talk about more was sort of the intersection of public and private. We talk about this convergence that's happening. And that's an emerging area where you suddenly have retail investors, you have wealth advisors starting to gain access to vehicles that essentially go beyond public and bring in the private. And that's new and different than what used to exist.
Well, let's talk about that. I cover ETFs for a living, and it's been interesting to see some issuers try to fit private assets into these publicly daily liquid vehicles. The Apollo State Street combination, for example, comes to mind. What is the Morningstar view on that, and basically this rush to put private assets into exchange-traded funds? Because there is a lot of skepticism out there and a lot of questions about sort of the liquidity mismatch.
Yeah. So first I'll start by saying that there probably already are some degree of private assets in other ETFs that have fixed income holdings. The line between public and private has blurred, and some people think certain things are in the private space and some in the public, but oftentimes you'll see them wrapped in there. But what we have not really seen full on is someone coming to market with a full-on private credit ETF. Now, State Street is trying to change that. But even there, the initial take is a mix of public and private assets, and they've done something unique in terms of how they are trying to make sure it's priced appropriately. So we're watching it carefully. We think there's some work to be done to sort of see how the mechanisms will play out, particularly in a stress market. But that level of innovation, I think, is likely just the tip of the spear in terms of what we're going to see, because more and more folks are going to try to bring liquidity to this space. And if you think about it, that's probably one of the main reasons people have not accessed the private markets in the way they have the public markets, because the liquidity tends to be an issue. And so firms like State Street I think are really trying to solve this problem. And I think the ETF that you referenced is probably the first of many such products we're likely to see.
Do you ever think we will see a true private credit, 100% pure play private asset ETF? Because like you said, you have seen the line blur. You have seen private assets make their way into some ETFs that also hold public assets as well. But do you think it's a possibility that we could have the real deal?
I think it's possible. I would say, does it make sense from an investment perspective? So if I go back and think about even the public markets, I remember when I was an analyst 25 years ago, we used to think of the world as bifurcated. You had an international fund, you had a domestic fund, and managers would concentrate in that fashion. And you still have some of that. But more and more managers moved to trying to have global strategies where they pick the best companies, the best credits, and they try to put them in one portfolio. And I think that's what you're going to happen here, too, is the lines between public and private will keep blurring. And so you're going to have offerings that can hold both and move across both to ensure that they're getting hold of the best assets. And even in our indexes and what we're trying to build out in that space, we started with the suite of public benchmarks. We've introduced private benchmarks, and I think the future is really in trying to blend some of those together, because that's how people's portfolios are structured.
No, we're trying to get a grasp on the health and vigor of your business, just the way you would when you're talking to fund managers. After S&P and Moody's cut their earnings outlooks last month, how do you compare with them and the big three in terms of market share, in terms of growth rates? Can you quantify some of these things for us?
Yeah, so in the private credit business, in the credit ratings business, which is what I think you're referring to, we're the world's 4th largest credit rating agency now. So we're a little bit smaller than the 3 legacy firms that you referenced. But where we are growing and where we're focused is, primarily in adjacencies. We're very strong in Canada. We own DBRS, and so that's the premier franchise in Canada. And so we're big partners to all financial institutions and issuers in Canada. And then, around the world, we've really tried to lean into areas where there's a premium on transparency, there is a premium on service, and where some of the barriers that exist in the fundamental corporate ratings business in elsewhere around the world don't exist, because there's more of a level playing field. And that's one of the interesting things about private credit And if you're trying to rate debt there, the playing field is far more level because it doesn't exist in the way that the traditional corporate fundamentals have existed, which have sort of favored, if you will, the legacy players in a way that some new markets do not.
All right, Kunal, we have to leave it there. Great to have some time with you on this Friday. That is Kunal Kapoor. He is the CEO of Morningstar. Meanwhile, let's get a check on these markets. You can see the S&P 500 holding on to gains, trying to make it for a fifth straight day in the green. You can see the NASDAQ 100 also trying to hold steady right now, up about 0.1%. It's pretty much an even split when you take a look at breadth on the S&P 500. And then you have the bond market pretty well behaved. You have the 10-year down about 2 basis points. Not much reaction to that University of Michigan sentiment data and inflation expectations. Pretty much quiet on that front. This is Open Interest.
Let's get a check on the market movers at this hour. We do that with the move screen, the most dynamic way to look at the S&P 500. First off, the breadth. I mean, we have 317 stocks rising, only 183 down. So basically 3-2 in terms of breadth. Not looking at big gains, but maybe that means that we'll finish at least up for a fifth straight day on the index. In terms of the gainers, Google right up there at the top. Then you've got Nvidia and Eli Lilly after Lars Fruergaard Jorgensen departs from, or at least steps down as CEO. Microsoft, Meta, and Broadcom ahead of AMAT as the biggest losers. If you look at the groups on the S&P 500, you'll see that they're almost all up, with healthcare leading the way. Energy, materials, and tech are down. When we come back, we're going to talk about Yuka trying to make America healthy again. Over 68 million people across the world are turning to Yuka to make healthier choices. The app reads product labels and analyzes the health impact of food products and cosmetics based on ingredients and additives. It has gotten an endorsement as well from the United States Secretary of Health and Human Services, Robert F. Kennedy Jr., which is interesting in itself. Joining us now is Julie Chapon, Yuka CEO. Great to have you here with us.
Thank you.
In New York, Julie. I got to ask you first about RFK, the endorsement. Obviously, it's an incredibly political thing, right? Because he's leading this sort of Trump movement, Make America Healthy Again. He's historically been anti-vaccine, and we're seeing a measles outbreak in the U.S. So how do you deal with that kind of issue if you want to remain apolitical?
Yes, so first of all, yes, we are totally apolitical, so we are not affiliated with any political movement or party. We are not affiliated to the MAHA movement. I'm glad to see that the issue of additives is gaining interest in this country, and we are definitely able to provide expertise and science-based information if needed while remaining independent. But yes, that's very important for us to remain strictly independent, both from brands and manufacturers, but also from politics.
I hear what you're saying, that you're an apolitical business, but that being said, that is a big endorsement to get. And I'm curious what sort of activity you saw after the fact, after RFK Jr. came out and said that.
What sort of...
Did you see more signups? Did you see more engagement?
Well, the growth has been extremely strong in the US for the past 3 years, so it was before all of this. So we don't see any specific acceleration due to the MAHA movement. This has started way before RFK come to power. So we don't see any specific acceleration due to the MAHA movement. It has really started a lot before.
We should point out to people who don't realize you're from France. Also, it's huge, right? I think you have like 70 million users of this app, and there's a free version, and I guess the way you make money is people step up to the pay version. What do you do to incentivize people to pay a subscription?
Yeah, so the app is free, and I mean, all the core features are free. You can scan for free, have recommendations for free, but we also have this premium version of the app that gives access to additional features, like a search bar, personalized alerts, and an offline mode. And in the US, we have 3% of our users that are premium members, which allows the app and the product to be sustainable and to generate profit. So we don't push it too much because what we generate is, for the moment, enough to make the project sustainable.
So you launched originally in France in 2017. You brought this to the U.S. in 2020. Obviously, additives are in the conversation in the mainstream in the U.S. right now. What does the breakdown look like globally when you look at France, when you look at U.S.?
So I can definitely say that there are much more additives in U.S. products than in France. To give you an example, like store-bought bread. In store-bought bread in the U.S., you have an average amount of 6 additives per product. In France, it's about 2 to 3 additives per product. So the difference is really huge. Another thing is that, well, here in the US, some additives are authorized, but they have been banned in other countries, especially in Europe, like titanium dioxide, which is a white food dye, is banned in European Union. But here you can find it in a lot of products. So yes, I think there is a lot of work to do here in the US.
And you're, I guess, making that work possible for users of the app, right? They can get on an email with the company from which they're buying a product, or they can tweet about it on X, demanding that they remove titanium dioxide or whatever it is. How is that working out?
Yeah, so the app gives information to the users to help make better choices, but we have also empowered consumers to push manufacturers to improve what's in their products. And so we launched this feature last November, which we call the call out feature, and it allows users to call out brands using high-risk additives. So they can call out brands by email or publicly on social media. They can call out brands on Instagram, LinkedIn, and X. And since November, more than 600,000 call outs have been made, which is really, really huge.
I am curious about how you plan on capturing and capitalizing on this moment, because you do have the RFK Jr. endorsement. I know that you're apolitical, but still, it feels like a lot of folks are looking into this in the U.S. for the first time in many cases. So how do you build on that and keep the momentum growing? Are you thinking about hiring? Are you investing in marketing? What does that look like?
We've never done advertising, and our growth has always been 100% organic in Europe and in the US too. The app has become popular thanks to word of mouth, with people sharing it to friends, with friends and family, and even with strangers at the supermarket. So we don't plan to do advertising or marketing campaign. The app has been existing for almost 10 years now, and it has never been linked in any country to political movement or parties. So we really think that what's happening in the US is here, and the topic of additives is great, to be honest. It's great for the US to have an interest in banning and doing something about additives. And well, we are here if we can help banning some additives, but we are also here to just inform people, inform consumers. And our mission is really to empower consumers. It's not to deal with politics. This is another area. We really deal with consumers and manufacturers.
But the problem is that I think a lot of people here are behind the additive exclusions that RFK Jr. celebrates, but he also is anti-vaccine, right? And so then you get a lot of parents who aren't vaccinating their kids anymore for measles and mumps, and now we have a measles outbreak in the U.S. Do you work with scientists to make sure you're pointing people in the right direction rather than, I guess, following along with everything that this whole movement, this populist movement seems to push?
Yes, of course, and I think that's really a very important point. So we have a strong scientific team that ensures that all our ratings and evaluation are really science-based. We really look at all the scientific studies, all comprehensive expert reports and independent studies with our team. And in the app, you can find all the information about the risks associated with each additive and all the scientific sources we base our evaluation on. So yes, that's very important for us to be science-based driven. Yeah.
And Julie, we don't have much time left, but I am curious. When it comes to acquisitions, when it comes to deals, we've seen several of them come through this week. Are you open to potentially being acquired?
No, that's not an option because, well, as I mentioned, we are independent, and being independent means that we keep control of the company.
All right, that's a good place to leave it. Really appreciate your time. Such a fascinating topic. That is Julie Chapone of Yuka. Meanwhile, let's get a check on these markets. A little over an hour into the U.S. trading day, the S&P 500 pretty much gave up its gains, pretty much flat at the moment. The color is still green. I can't say the same for the NASDAQ 100 and your big tech names there, down about 0.2%. All the S&P 500 needs to do is close green, and then it'll be a fifth straight day of gains. But it seems like that momentum is fading now.
Right, and we need to get to 59.79. To be in a bull market. Still has good breadth. 322 stocks are up, 177 are down. House Republicans have hit a wall on their budget plan, and we're going to go live to Capitol Hill to figure out if we can give them a little help next. This is Open Interest.
Well, House Republicans have not resolved several major disputes that threaten to derail President Trump's domestic policy bill as more conservative members and blue state Republicans dig in on their demands. House Speaker Mike Johnson told Bloomberg yesterday that he remains optimistic on the progress.
We got a few pieces yet to solve, but I think we're going to do that over the weekend. So we're moving the dials, as I said earlier. There's enough things to adjust to make it happen.
You offered them a new number?
I'm not going to tell you what I've offered. We're negotiating with a number of members, a number of caucuses, and we'll get there. So stick to it.
Do you think the negotiations are close enough to actually get something done by the end of the week?
I do. You know me, I'm an optimist. We move forward. We've been demonstrating that every step of the way, and we're going to do it again.
President Trump, meanwhile, is berating Republicans to stop talking and pass tax cuts. Joining us now on the latest is Bloomberg's Tyler Kendall reporting from Capitol Hill. The president also said that Republicans must unite behind the big, beautiful bill. Where do we stand right now?
Yeah, hey, Katie. Well, there's still some really big sticking points here, which could threaten House Speaker Mike Johnson's timeline to get reconciliation through the House by Memorial Day. Of course, one of the biggest ones is SALT. You mentioned there these Republicans from high-tax blue states who say that lifting that SALT cap from $10,000 to $30,000 ultimately won't be enough. We had Mike Lawler on Bloomberg television earlier today, a Republican from New York, who said they're also still trying to hammer out a bunch of other issues related to SALT, including the marriage penalty, income limits, and then what would ultimately happen to a lifted cap? Would it be phased out or have some sort of expiration date tied to it? But what I found most interesting about what he told us is that he said he's going to request a phone call with President Trump this weekend when he gets back from the Middle East. It is clear that these Republicans are trying to use their leverage where they can when it comes to these negotiations. The other side of this, though, the other Republicans using their leverage are those fiscal hawks who right now are threatening to derail this process. As we speak, there's a budget committee hearing going on here on Capitol Hill. This is supposed to be routine. This is where they bundle up the different parts of the package, wrap it up into one big legislative bill and try to move it forward. But now these fiscal hawks are threatening to vote against it in this committee because they want to see some more savings cuts down the road. Now, Katie, I actually had the chance to catch up with one of them, Congressman Chip Roy, a Republican from Texas. He comes up a lot because he's one of the most perhaps vocal members when it comes to the House Freedom Caucus, and he told me there's still a long way to go here.
I wonder, Tyler, if Chip Roy wouldn't be happier to just let the TCJA expire. Certainly for New York Republicans like Lolota, like Malliotakis, like Stefanik, New York and New Jersey Republicans, even Young Kim out in California, wouldn't it make sense to let this cap on state and local tax deductions sunset? Because they need to do what's best for their own constituents. Why would they accept any cap?
Right, well, that's their argument. Mike Lawler was asked basically this exact question: what sort of other savings would he want to see? And they argue that it is a savings to have a cap at all because there wasn't a cap before 2017 and they could just ultimately let this end up expiring and then it would go away. But at the end of the day, we have to, of course, think about the broader picture here, which is that they decided to do this as one big, beautiful bill, which means, yes, they get to fast track the process. Yes, they don't need to negotiate with Democrats, but they ultimately do need to negotiate with each other because all of of these priorities that this White House is really banking on, including trying to front load some of these tax cuts to get more money to consumers faster, so it all goes together with the broader economic agenda, including the concerns about the tariffs. It all has to be done in one bill, not to mention, of course, also they're trying to increase the debt limit in this bill, too. It's going to be a long weekend ahead, but we're expecting negotiations to continue.
A lot to do, and the clock is ticking. Tyler, Kendall, really appreciate your reporting from Capitol Hill.
All right, time now for our Wall Street Week conversation. Over the past decade, Sweden has had more IPOs than the rest of Europe, second only to the UK. David Weston sat down with NASDAQ CEO Adina Friedman at its Nordic headquarters in Stockholm to discuss the country's strong market structure.
We operate our markets here and also in the Nordics. We own and operate almost all the markets in the Nordics.
We spoke to NASDAQ CEO Adina Friedman in New York in April, not long after President Trump had roiled the markets with his sweeping tariff announcements.
So on options in 2024, we had an average of about 24 million contracts traded a day. On Friday, we had 94 million contracts traded. Now, what generates that, though, what's really, really interesting is options markets are extremely data heavy.
Friedman and her NASDAQ team have plenty to handle with U.S. markets, but they also run European operations almost as large in what they call NASDAQ Nordic, which became part of the group in 2008. We accompanied Friedman on a trip to their European headquarters in Stockholm.
Well, Stockholm is one of the great markets that we own and operate here in the Nordics, but it also is the headquarters to our market technology business, where we serve 130 markets with our technology that helps them power all the markets, those markets around the world as well.
How much of NASDAQ's overall operation is represented in Stockholm?
Well, we have about 800 employees here in Stockholm, slightly smaller than New York, where we have about 1,000 employees in our New York office. So it kind of gives you a sense that this really is our second headquarters in the world. It's one of the special places that I get the benefit of being able to come to as we engage with the markets here in Sweden. One of the things that I find interesting is how similar it is here in Sweden versus New York. So the markets in Sweden have a lot of characteristics to the markets in the U.S., which is different than the rest of Europe. So when we look at it, we look at, well, how liquid are the markets? How many new companies come and list here in any given year? How active are the markets in terms of having retail ownership of equities? And in many, many cases, those are very similar to the U.S. So we have 1,200 companies that are listed in the Nordics. And in any given year, we'll have dozens of companies list here, both small companies on our SME market, which is called First North, and on the main market. So we're really, really proud of the fact that the markets here are very vibrant and have a lot of similarities to what we see in the U.S., but sitting here in Europe.
One sign of its strong capital markets is Sweden's IPO pace. Between 2013 and 2024, there were more IPOs in Sweden than in Italy, France, or Germany, second in Europe only to the UK.
The U.S. markets are the largest, deepest, most liquid markets in the world. But when you look at that, how that's translated into the markets here in the Nordics, it actually has a lot of the commonalities. The market cap of the listed companies here in the Nordics are about $2 trillion versus, of course, we have about $30 trillion in the United States just on NASDAQ. However, the liquidity that underpins that market cap here in the Nordics is quite vibrant, very active.
And that was David Weston on NASDAQ's European operations. You can catch Wall Street Week tonight and every Friday at 6 p.m. New York time. This is Bloomberg Open Interest. Well, stocks are back in vogue in the $11 trillion U.S. ETF industry, following weeks of outflows triggered by President Trump's trade onslaught. Inflows to equity tracking ETFs have surpassed fixed income funds as investors really embrace the trade relief rally. Stock ETFs have absorbed nearly $41 billion this year alone versus a $29 billion haul for bond funds. Let's discuss with Bloomberg Intelligence senior ETF analyst Eric Balchunas, who joins us now. And Eric, this is how it typically is. Typically, it's stocks that are more popular than bonds when you take a look at the flow show. Now we're back to normal. What caused the flip?
Yeah, I don't think the flip was as dramatic. There was just, when Trump went after Powell that one time,
I felt there was a little bit of a pullback in the flows. But up until that point, the tariff tantrum, most of the ETF investors kept investing like it was no big deal. There was 2 weeks there where they pulled back a little bit. But then even within the pullback, you do have the Vanguard flows were steady, but some of the trading crowd pulled back a little. Now people are pretty much back in. You look at the top 5 flows, top 10 flows, it's kind of what you saw last year. It's beta with the side of Bitcoin, VU, Qs, and IBIT. And this is kind of, again, back to where we were. I think most people are a little, kind of beyond the tariff situation. We'll see what happens in earnings and whatnot. But I would say for the most part, the retail ETF investors probably made the right move the last few months by just buying. I think they remember what happened in COVID, where if you didn't hang in there, you missed that huge rally up. Kind of had a deja vu situation again.
By the way, index tracking has gone terribly well for retail investors for the last 15 years. If we make a switch to active, if people decide that that's the way to go amidst this volatility, does that hurt ETFs, or have we had, I've seen ETF IQ, your show, so many active ETF launches that you'd still see the same kind of growth?
Yeah, so active is really making its mark in the ETF world. So active is alive and well. What it did, though, and the reason it's working and people are buying it now, is it beta adjusted its fees. If you're, low tracking error, you're lower fee. So DFA, Capital Group, Avantis, they're all under like 30 bips now. And so I think a lot of advisors and investors are willing, they want active sometimes, but they don't want to pay too much for it or pay like 1% for largely the S&P 500.
Right.
So I think the fees have gotten more appetizing. And with the fees lower, the chance of outperformance goes up. So their beat rates are probably going to improve. And so active got more competitive, basically, and they're finding success. I'm not surprised.
Well, let's talk a little bit more about this shift to active and what it means for a lot of these issuers. You named a few of them who are big in the active space. You had an interesting note out this morning that, okay, we're talking about 30 bips. That's still much higher than 3 basis points. And these ETF issuers, they're seeing more in terms of revenue than they were when it was really just passive. That was all investors wanted.
Yeah, it's interesting. The average fee of ETFs is going up, although the asset-weighted average fee is flatlined at about 17 bips. So generally speaking, the big blob of money is in low-cost beta. But because low-cost beta is like a territory that's just had, like, what are you going to do, compete against Vanguard? A lot of the new products are pretty crazy. I mean, they're 2x NVIDIA, 2x like AI stocks and stuff, and buffers. All those charge like above 80 basis points. So we study it because everybody's looking for how can we make money in this market. And there have been ways to get organic assets with this sort of new style of active that does some stuff with options and derivatives. But your grandfather's active, the stock picking, which is what I mentioned earlier, in my opinion, that's just they got more competitive on fee story. But this new school active charges way more. And you're going to see a lot of launches in the latter category because you can make more money there. And you only need a couple hit products to be profitable.
All right, Eric, got to leave it there. Really appreciate the time. That is Eric Balchunas of Bloomberg Intelligence. And you can tune into our show, ETF IQ, on Mondays at 12 p.m. New York time. We host it with Scarlett Fu. I also write a newsletter of the same name, Bloomberg.com/ETF IQ newsletter, that is.
I wanted just to point out, as we go to break here, President Trump has tweeted a couple of things about musicians today.
He certainly has.
First, this morning he said, has anyone noticed that since I said I hate Taylor Swift, she's no longer hot?
What does that mean? She is
now,
the biggest
on
pop
Bruce
star.
Springsteen, President Trump says, never liked him, never liked his music, and importantly, he's not a talented guy.
Brutal for New Jersey.